I'm Timbekile Mkhototo. Good to have your company on this Africa Day. There's more pain, unfortunately, ahead for indebted South Africans after the Reserve Bank today hiked interest rates by another 50 basis points. It marks the 10th consecutive increase since the hike cycle began, taking interest rates to a 14-year high as the central bank is looking to tame high inflation. The rand slumped to a record low against the US dollar moments after the announcement. The prime lending rate, which is what banks charge consumers, is now sitting at 11.75%.
PC decided to increase the repurchase rate by 50 basis points to 8.25% per year with effect from the 26th of May 2023. The decision was unanimous.
Well, the central bank has revised upwards South African and global growth prospects, for this and next year. But Governor Lesotho Kganyago says that load shedding is still a major concern.
For 2023, the bank's forecast for GDP growth is slightly higher at 0.3%. Energy and logistical constraints remain binding on South Africa's growth outlook, limiting economic activity and increasing costs. We estimate load shedding alone to deduct 2 percentage points from growth this year.
Sugar Creek Wealth Managing Partner Gerald joins us now to talk about the impact of the rate hike on you and I, people who have loans or are repaying cars as well. Gerald, good to have your time tonight. Let me get your thoughts first on the rate increase, the 10th one in a row.
Look, Tabekile, I think this rate increase has taken us into unknown territory. From a financial planning point of view, normally when you take out a home loan, people are advised to borrow 75% of what they can afford, so that if interest rates go up by another 25%, you can cope. We have now experienced rate hikes which are equivalent to over 40% increase on a bond repayment since the beginning of COVID, or since the rate hike started. Most people have reached the end of their tether. I think this might be the straw that breaks the camel's back, because for a household which is paying a 1 million rand bond, their bond has gone up basically by 3,500 rand, and it's money we simply don't have because interest rates have also pushed up inflation and the cost of living has gone up while salaries haven't.
And when you say this may be the straw that breaks the camel's back, what do you expect that to look like in a South African context?
Look, remember that the prime rate does not only refer to home loans. It means your credit card has gone up. It means that your car payment has gone up and your personal loan. People simply don't have the money anymore. In real terms, we're earning almost 50% of what we were earning in 2018. So we are getting poorer, but our bills are getting more excessive. In terms of interest rate policy, it can start having unintended consequences. And already you can see the rand reaching a low because of the unintended impact of this rate hike. And there could be other things to follow. This could indeed be a winter of discontent because South African public has been tolerant for a long time. But it reaches a point where people simply don't have the money. And when people's livelihoods and homes are on the line, behavior can change.
And it has to be seen within the broader context, right? So, yes, you're paying more for your car repayment, your mortgage, your loans, your credit card, etc. But also, people are paying more for food. They're paying more for school fees.
Look, yes, indeed. You can only stretch a limited salary so far. Remember, the biggest pot of money in South Africa is actually being held by corporates who are saving it. And ironically, these rate hikes are great for them. They're making a lot of money without doing anything. But we're actually supposed to be driving the economy in terms of economic activity so that we stimulate industry. And I think the government needs to find the other ways of managing the economy and not just using the interest rates as their primary tool. Because all the factors that have led to these rate hikes have nothing to do with South Africa. It's global fuel prices, the war in Ukraine, and a lot of external factors which are affecting us, including South Africa being perceived as allied with Russia.
And given that many of the factors that are affecting the picture here at home are driven by not domestic but global influences, was this the only option that the Reserve Bank had at this point? Was this an unavoidable rate hike?
Look, I think the Reserve Bank only is a bit myopic at times because they only use interest rates as their tool of managing the economy. But even the governor himself said that they've probably reached a ceiling in terms of how far they can push interest rates, because they do know that at some point people simply will stop paying or they won't have enough money. Economists still forecast another 1 or 2 rate hikes going ahead. However, I do feel that there needs to be a bit more empathy, because South Africans are already reeling from load shedding. So you're spending more on energy because you have to use primary electricity plus an alternative energy source just to survive. And I think, we have to be realistic and start finding other ways of driving the economy which do not necessarily punish the consumer.
Gerald Mwandiambira, good to speak to you. Thank you so much for being with us tonight.